Hello there and welcome to Share Views, where I'm joined by Ed Bowsher, who is a financial journalist, somebody who's not new to the game, I believe, Ed.
No, well, I've been investing since '97 for 20 years now, and as a journalist I've been all over the place. My last job, I was a presenter at Share Radio, and I was also deputy editor at Money Week, and I was the editor of The Motley Fool. Been all over the place, but really, fundamentally, I'm an investor, and I do the journalism to get some money coming into the bank account at the same time.
And do you think, the markets, you've been around the block, have the markets changed for the ordinary investor over the last 20 years?
Good question. I think, there's fewer, I think, exciting companies coming to the market now, and I think a lot of sort of younger businesses are coming to the market at a later stage in their development, which I think is a shame for private investors. So it does make it harder to find those sort of shares that will go up 5 times, 10 times the sort of shares that private investors dream about. So
it's gone sort of from maybe the crowdfunding and then straight to the AIM market or the full listing. There's nothing much in between. That's right.
I think, the old OFX index, which you all now will remember, is pretty much dead now under a new guise. So, yeah.
Well, I'm sure the next exchange will be delighted to hear your comments there. All right. Yesterday we had the Fed giving their utterances for July. Not a big month normally for the Fed to do anything, but what was your take on all that?
Well, the interesting thing was they're saying that inflation is perhaps a bit more subdued than they expected. So that suggests we're probably going to get fewer interest rate rises in the US over the next year. But at the same time, they've carried on talking about this idea that they may start to reverse QE. And some of their comments suggested they may start doing that in September. So in other words, remember, with QE, they create a lot of money, bought a lot of bonds. Come September, they may start actually selling the bonds. And that's going to make a lot of investors nervous, because the concern is that once QE goes into reverse, markets will be hit. We've had a fantastic time for investors since 2009, over the last 8 years, most assets going up very strongly, and I think a lot of that is down to QE, so we need to be nervous the next year or so.
But is it going to be a slow puncture of the asset bubble, or is it going to go pop? And well, that's the big question.
It is the hard one to call, because we are in uncharted territory. We've never really been through this before. My best guess is it's going to be a slow pop, but I wouldn't sort of put a lot of money on that.
Right, and in terms of what strategies investors have at this stage, which is, let's say the easy, well, now it's over, we think it's over 8-9 years of easy money and relatively easy trading. What are the areas in the market, let's say in the stock market, that you would be looking at now?
Well, I'll carry on investing. That's the first point. Secondly, I'm more interested in the large cap stocks these days, because I think a lot of private investors underestimate the kind of returns you can get there. And when you look at small caps, I still have some small cap investments, but I think they are particularly vulnerable to the problems of Brexit that are coming around the corner as well. So I'm gloomy about Brexit, and I'm a bit gloomy about QE, and most of the small caps, excluding some Chinese things, they're very much UK-focused businesses. So I'll keep some of the things I've got, but I'm not going to be putting extra money into that part of the market in the near future.
Does that mean we're looking at, let's say, bargain hunting in blue chips when they take a tumble? Let's say BT with the accounting scandal, or AstraZeneca with its latest drugs trial issue?
I think you definitely need to be looking at those blue chips when they do fall and asking, is this bargain time? Astra, as you say, a big story today, down now to about £43. Pfizer offered £55 a share for it not so long ago.
Well, money isn't everything, is it?
No, it isn't. I should say, I shouldn't be smiling. I'm actually an Astra shareholder, so I'm pretty fed up today. But I think actually this fall is a bit overdone. Yes, this whole MYSTIC trial is important for Astra. This is big new immunotherapy for lung cancer. There's more trial results coming next year. They may well be as bad, but there's a chance they'll be better. There is another lung cancer product coming through with Astra called Targrisso, and it had good results today. It's still paying a decent dividend, so I'm not too gloomy, although today's news is disappointing. But yes, some people might be thinking that's a bit of a bargain to go for.
That's the thing with drugs companies. You see this over the years, maybe with that perspective, that you have one failure amongst 100 drugs that they produce, and the share price goes down by 10%. Which is not the right proportion to the the issue that's happened.
I mean, often that's the case. I mean, Mystic, though, this trial that's gone wrong, or at least gone wrong so far, is a big, massive one for Astra. And the CEO, sorry, has been talking a lot about immunotherapy, this new way to treat cancer. So I can understand why the shares have fallen so much, but I think it is overdone. But it is tough with these big pharma stocks because you can't just look at the dividend yield or the price-earnings ratio. You know, they're a bit like a property company. The underlying value of the assets, the drugs, is really important.
Right. The other thing is, I mean, you look around different sectors. I mean, the drug sector has its own peculiar habits. We've had, again, many years of harvest, a good harvest in the real estate area. You think that there's going to be a change there?
I think so. Well, we had some interesting news today. Landsec, used to be called Land Securities, they've changed their name for no good reason. They today are selling the big tower, relatively new tower in the city called the Walkie Talkie, or they own 50%, Canary Wharf own 50%, selling it to some Chinese investors. And the Landsec CEOs basically said, I wasn't planning to sell this one, but the offer is just too good. Now, the really interesting thing about this, I think, is that Landsec are returning most of the proceeds to shareholders through share buybacks and dividends. They're not actually going to invest it in a new block in the city or elsewhere. And that says to me then they're pretty bearish about the commercial property market and perhaps worried about what Brexit might do to the commercial property market, particularly in the city.
Do you think it's Brexit which is the problem, or do you think it's actually that's a call on just valuations? Or both?
I think it's probably both. I think it is probably both. But I do think Brexit's a very important part about it. Personally, I think a lot of people are still underestimating the number of jobs that could leave the city and go elsewhere over the next 5 years or so. And it is interesting that Landsec have made this decision.
Right, switching sectors again. Diageo stood out for me today with their share buyback, £1.5 billion. That could have got them almost half of Fever-Tree if they've been feeling adventurous. What is that saying? Because that also sounds like a bit of a defensive move.
It does, but there's good underlying results there. Good organic growth, sales up, organic sales up, I think at least 6%. So they've got the sort of financial strength to do it. And the nice thing about Diageo, you might see it as a pretty boring company, but it's a good global business. It's not that exposed to the UK market. So I can understand why shares have hit a record high today.
Right. And just speaking of Fever-Tree, is there any valuation with your many years of experience? Can you give us tell us what the proper valuation is there?
Fever-Tree is frustrating because I've been tempted to go in many times over the last whatever it is. I think it's about 2.5 years now, isn't it, since it listed? Yeah. Never have. Obviously regret it, but it seems crazily overvalued now. But what can you do?
But is that a share which gathers its own momentum? Fund managers go in and it creates its own tsunami effect.
Perhaps it does, yeah. But I spoke to Harry Nimmo, well-known small-cap manager, about it 3 or 4 months ago. He was on the record, and he was just, he got in at a fairly early stage. And I said, why don't you sell? And he basically admitted it was pricey, but he wasn't going to sell it too early. He was just hanging on as a momentum play, a momentum hold, if you like.
Right. I mean, one of the characteristics of the market, which you said the opportunities aren't there as they were, the IPOs. I mean, is that a good place to buy? A good time to buy into a company?
I'm always nervous, actually, because yes, fine, you get the Fever-Trees, but you also get other ones. AO World, as an example, has done pretty badly, and the amount of information that's out there isn't that great. And also, I think the disparity in information between what the people in the city get and the private investor get is actually greater at the time of the IPO. It's hard for the private investors to get hold of the IPO documents. The city get lots of private chats. A year down the line, you've got real solid annual reports, RNS statements, and actually the private investors in a better situation relative to the city than he was a year earlier.
Right, I don't want to go on about you being an experienced hand or anything like that, but people who are investing maybe on a casual basis but want to get serious about it. Are there any sort of particular golden rules that you would actually stand by?
Think long term. That one is the absolute biggest one for me. Don't get obsessed about trying to get those 5 and 10 baggers. Personally, when I started investing, it was the early days of the technology boom, and I did make a lot of money, but then got sucked into more and more rubbish. After that, I did start looking at the oil stocks in the noughties, which did do well for a while as the oil price rose a long way. But I got overly obsessed about looking for the ones with the greatest potential to do well, and often got caught out. And actually, at the time, just buying some pretty solid and sensible E&P exploration and production companies at the time would have done me just fine. So that's my biggest lesson, actually. Don't be afraid of companies in the FTSE or in the mid-cap index, or indeed overseas businesses, big American businesses. I've made a lot of money from big American businesses in the last few years.
So basically, companies that will always need their services.
Yeah, I think so. And don't be too greedy. You know, my biggest successes in recent years have been Facebook, Amazon, Alphabet. You could argue now they're getting too high. You know, there's a lot of research saying that over the long term, actually value shares that look relatively cheap, do better than growth shares. And of course, Facebook and Amazon don't look relatively cheap. They're classic growth shares. But I'm going to hang on in spite of all the rises, because I do think those particular companies are really disruptive companies that really are changing the sectors that they're in. And I think over the long term, they will continue to perform, even if we do get some wobbles over the next year or two if QE is sort of wound back.
That's it for this week's Share Views, brought to you by London South East, lse.co.uk, and thank you to Ed Bowsher.